Welcome to the Zandbergen Report, where wealth strategies and pop culture collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.
Welcome to our show of Dream Chasers and Wealth Makers. We are thrilled to be back in the studio today with a new episode of the Zandbergen Report. I'm proud to bring in the movers, shakers, and difference makers who are passionate about sharing what they have learned and what you need to know today. Hello, ladies and gentlemen. Glad to be back in studio with Letitia Berbaum. Today, we are going to discuss a question that seems to be on everybody's mind, and that's recession.
Yep, the big R word.
Big R word. So Tish and I, we leaned into one of our investment partners, which is Capital Group, and they have done some extensive research, and we got from them what they consider the 9 key things you need to know about recessions. Sounds like fun, right?
Yeah, well, I think the most important thing to get out of this show is what are the indicators, and we're going to talk about the different things of the 9 pieces for each, but hopefully that this can make it a little bit more easy to understand what's going on. Yeah,
that's for sure. I mean, the question I think we hear most is like, how bad will this recession be? And the answer is no one knows, right? No one knows for sure.
Yeah.
But if we compare it, the last one was 2008, the global financial crisis. There was many different things going on then that are happening now.
Yeah.
And for that reason, many are saying that this one, while we will most likely be in a recession, and most are thinking it will be early 2023, will not be as bad as the last, but I guess we will see. So let's go through the points. There's 9 key things. And the first one is, really, what is a recession? And I think many listeners may not know exactly what defines a recession.
Yeah.
So Tish, do you want to define it?
No, you can define it.
So a recession is commonly defined as at least 2 consecutive quarters of declining GDP, or gross domestic product, after a period of growth.
So that's the definition.
Mm-hmm.
And a lot of times it's felt before those 2 negative GDP quarters have hit. So that's something
Correct.
People should know.
Especially in the stock market. We're going to get to that. So, but I might as well mention it here.
Yeah.
Is we were talking about this a little bit before we went on air, but the stock market is a leading indicator. So as it comes to investing, many times the stock market will have volatility prior to going into a recession.
Yeah.
And will start to recover.
Yeah.
While we're not yet out of a recession.
Right.
So that's part of the pain I think people are feeling.
Yeah, and just so people understand, that's why you feel it ahead of time, is what the market does is it factors in the changes that it's seeing ahead, and then it starts to move in a direction. And then if that doesn't happen, it kind of self-corrects. But that's what people, they don't always understand that element. And
Right.
So people, by the time it's quote unquote identified as a recession, people already have felt like we've been there for a while, in which we have. And so that's why I like to just identify that.
Okay, that was good clarification.
Okay, what causes a recession,
so
Bart?
number 2, what causes a recession? Well, past recessions have been caused for many reasons, but typically it's a result of economic imbalances that ultimately need to be corrected. And then let's use 2008 as an example.
Okay.
That was caused by excess debt in the housing market.
Yeah.
And then the 2001 contraction was caused by an asset bubble in technology stocks.
Right.
So we had, what may or may not have been the trigger was the pandemic from a year and a half ago.
Yeah.
And that had widespread damage corporate profits and trigger job cuts and et cetera. And while unemployment rises, consumer typically reduces spending with further pressures on economic growth, company earnings, and stock prices. So a lot of things that go into this. I love this quote from Capital Group's vice chair. His name is Rob Lovelace, and he's been in the business for about 50 years. He says, "You can't have a sustained period of growth without an occasional downturn to balance things out. It's normal, it's expected, and it's healthy."
Yeah.
So,
I feel like a pullback is the market's way of taking a breath before it can go back up even more.
Exactly. And we kind of referenced that in our last show when we were talking about, the market volatility and investor behavior. But it's looking at a longer time horizon in your investment returns,
Right.
I think is extremely important. And I think that speaks to that.
So I want to emphasize time again. So number 3 is how long does a recession last? And what I said, remember, before when I was saying, hey, you may have felt like you were in a recession before it even was called an official recession, right? Now, how long does it last? What typically when it's been identified as a recession, those 2 negative GDPs?
Correct. So and that's actually some of the good news is it's not as long as I think most people think.
Feels like forever. But it's not.
Right.
Yeah.
So we looked at the last 11 recession cycles going back to 1950.
Right.
And it shows that they lasted or persisted for anywhere between 2 months and 18 months.
But the average is about 10
Is about
months.
10. So that's not so bad. That's a school year.
Yeah. And okay, so I'm going to throw the compliance thing out there is what happened in the past does not mean that it's going to happen again in the future.
Great point.
And depending on how much, like we talked about in our last show, depending on how much risk you are taking, it might take you a different time horizon to get back to where you were. But in general, if you're wanting just to understand how long does the recession last and how long does that cycle average, we talked about around 10 months on average historically.
Yes, but I do want to clarify that's 2 conversations.
Yeah.
1, your portfolio return, and 2, the recession. So 2 different things, but seem to be commingled, but they are just for clarification purposes.
They both feel awful.
Yeah.
At the time.
All right. Point number 4 is what happens to the stock market during a recession? Well, anybody looked in the news today?
Yeah.
That's pretty much what happens. We have volatility.
Right.
Now, speaking of the 2 different things, so we have 1, recession, which we're talking about on today's show.
Yeah.
And then we have something called a bear market.
Yeah.
And a bear market is when the market declines 20% or more. More often, these 2 overlap. With a recession comes a bear market.
Yeah.
Not always.
Yeah. Well, like you saw in the last thing, I just insinuated it was the same because it's pretty common.
It's pretty common.
But not always.
Correct. And so to answer the question, what happens to the stock market during recession, more often than not, we see at the very least volatility, more often a bear market.
Yeah.
But I'm going to repeat what I said earlier, look at the bright side because that's how I look at things. The stock market is a leading indicator, and sometimes by 6 to 7 months. So we could be 6, with that said, 6 or 7 months before the recession, stock market's going to start getting wonky.
Yeah.
6 or 7 months on average.
Yeah.
Before we're out of a recession, we could start to see a market
recovery.
So.
Yeah. And that's what I talked about earlier, right? The market is starting to see that there's more confidence, but the numbers aren't out yet to support it. So until then it's not marked as being a completed recession or the beginning of a recession.
Yeah. So, and just as a reminder also, sometimes the strongest returns in the stock market are in the late phase of a recession. So for those that were thinking, but going back to our previous show, market investor behavior, kind of the bottom of the mountain, panic, sell out. Well, you're potentially missing some of the best opportunity for recovery.
Right.
All right. Number 5, what economic indicators can warn of a recession? Wouldn't it be great if we just had a
crystal ball
or like a light goes on, recession.
Well, there's some things that tell us that it might be on the horizon.
They're signals.
Yeah.
Right. There are
signals.
signals.
We're not talking smoke signals here, though.
Right.
I mean,
yeah. It's not the flashing light.
No.
So typically it's a
Warning
combination of a number of things. And that list of things are in the inverted yield curve.
Yep.
And for those that's a kind of a complicated concept, but that's when the 10-year yields are lower or below the 2-year yield.
Right. And then they call it inverted.
Inverted.
Yep.
Now, every inverted yield curve does not guarantee a recession,
No,
but every recession seems to have an inverted yield curve.
that's right.
All right.
That's why it's one of the indicators.
Correct. Yep. The other one is unemployment,
Right.
rising from cycle trough, so rising. Consumer confidence declining from the previous year.
Yeah.
Housing starts, so that's a number that has been starting to flash, declining at least 10% from the previous year.
Yeah.
I think we're getting close to that right now. And then the leading economic index declining at least 1% from the previous year.
So what's really interesting, I'm going to just kind of connect this to the markets. Sometimes you turn on the news and you're like, what is going on today?
Yeah.
I don't understand what's going on. And we know that, like you said, we're in a little bit more of a volatile time period and everyone's watching what's going on. But behind the scenes, what's unfolding is there is market updates on what's going on with unemployment, right? The housing numbers. So these indicators are coming out, and then all of a sudden, if the indicator is showing that it's dropping again on one of these indicators here, then what the market does is then it reacts, right?
Correct.
And it says, oh, that's another check mark on the indicator list that we potentially are heading towards a recession. And if that's the case, then let's dial it down. And then what happens is automatically the market becomes more volatile. That's what's happening behind the scenes. Not always, but I don't know about you. If you're ever turning on the TV, you're like, well, I don't know if any major political issue is going on today. Is that what's causing it? No, it's during this market. Everyone is looking at these indicators to see, are we getting closer and closer to a recession?
That's right. That's right.
So, Bart, how do
Question
we know?
number 6.
Are we in a
Are we?
recession?
Well, I think just to add on what you were just previously saying with all the news flashes, I think many people think we're already in one.
Right. It feels like
some
it.
experts think yes, some no.
Right.
It seems that the majority believe that it's probably going to be 2023.
Yeah.
Because the indicators that we just spoke of, they're just not all aligned. And
Right.
then we haven't had the negative GDP numbers
Right.
consecutive.
Right.
So,
And that's it. That's why we talked about that in the very beginning, right? That is the true definition. So until it hits until it actually hits that, then it's not technically called the recession, but
Right.
everyone can feel it coming.
now, I will add one, let's call it a wild card.
Okay, talk
That's
to me.
geopolitical
Yeah.
risks or shocks.
Right.
It's no mystery. We've got issues going on between Ukraine and Russia,
Yeah.
and that could quicken,
Yeah.
I think, things towards a recession.
Right.
And that falls into that geopolitical.
Yeah, and think about it this way. If you already have a market that is, let's just call it volatile, rocky, unstable, and then you have something that's geopolitical, it can just kind of tip it over.
Right. Okay, number 7, how should you position your stock portfolio for a recession? Well, we've already established that equities or stocks are going to be more volatile. So is now the time to sell all your stocks? We're going to say no, right? They've already taken some correction. We know that in many cases we have great companies, great funds, great managers, and as Rob Lovelace said, it happens, it's healthy, there are things to have some repricing. And quite frankly, we didn't talk much about what we were doing, but we were using this as an opportunity in some cases to find great companies that some we are already invested in. Wow, we liked it last year at a price that was 30% higher. Maybe we should buy some more.
Yeah, and there's a lot more that goes behind portfolio
I simplified.
construction. Yeah, and what we do on a day-to-day basis. But in general, I think every market condition has a little bit of a different spin to it of what's going on. And the words that people have been using right now is inflation quite a bit and increasing interest rates. And so those two things are something to take in consideration when you're repositioning your portfolio and you're looking at that big picture outlook. And so if you're weathering this storm, you have to understand what your risk tolerance is and how comfortable you are with that. What is your time horizon? If you need something, you're saving for a home to buy in the next 6 months, then you have to take in consideration the amount of risk that you are putting that investment in to have it in the market during this time. Call it like the seas, it's choppy, right? Versus, hey, maybe I make sure that I'm invested in a way that I feel comfortable with that amount of risk in that time horizon.
Yeah, that actually plays right into a point I was going to make is it's a perfect time to review.
Yes.
You know, talk to your advisor, review your allocation.
Yeah.
Maybe you've drifted to a more aggressive or more growth-oriented that's not in your normal wheelhouse.
Right.
Maybe it's time to tone it down. Maybe it's time to add some assets that do better in rising inflation and rising interest rates.
That's right.
So this is a great time to do a review.
Yeah, this is a great time to connect with your advisor, revisit your portfolios. And, you know, I hear all too often people just take their statements and just throw it in the drawer. They don't want to open it up and look at it. They might be afraid. But truly, you know, people like us are out here to help support and guide and be sure that you can sleep at night and take off that worry for you. And so let's help you get to that destination. And simple things like making sure your allocation is correct. It's a great time to rebalance if you haven't rebalanced, or make sure that you're diversified if you're not diversified. If you have a concentrated allocation to something, then maybe it's time to make that slight shift. So, you know, go ahead.
Yeah, and the slight shift might be what type of equity or equity funds do you own?
Yeah.
Because not every equity is destined to lose money.
Yeah.
There are sectors that over the past declines have done well, consumer staples, healthcare, utilities. Again, not sure if they're going to do well this period, but in the past they have tended to do better during market declines and recessions.
Right. And as compliance would say, previous returns is not a guarantee for future returns. But in general, I think if you feel like you are not comfortable with where your investment is, it's okay to have someone take a look at it and make sure that you are on track.
Yeah, for sure. So we talked about what to do with your equities in your portfolio. Point number 8 is how should you position your bond portfolio? Well, if you remember from the last episode, the bonds are off to the worst start in the history of recording.
Yeah. Before you say that, I want to make sure that we're emphasizing why. Why is that a problem? Because bonds are traditionally the safe asset.
Right.
And when they're
conservative.
Right. And then when they're down for the worst returns in history, it's not really funny. It's more of a nervous laugh.
Yeah.
But you have to think, okay, where are we going for the future? The interest rates are going up, right? That affects bonds. Bart's going to explain to you. It's just math. But
that's a math also. And without complicating things, the simple high level is as interest rates go up, the value of existing bonds go down.
Okay, so then how do you protect that?
So you buy new issue bonds with higher interest rates.
And if you already have bonds,
you hold to maturity and get your par value back.
Right.
So bonds are still a good safe play.
Perfect.
And you and I are looking at some bonds that are treasuries that are looking very positive right now. So it's still something that should be in your portfolio, but we both suggest you talk to your advisor to see what's the best
for your
bond.
Investment objective.
Exactly right. We are at number 9, the 9 points that we promised. And number 9 is, what should you do to prepare for a recession?
We've kind of talked
inevitable.
A lot about this already.
So I think the best piece of advice we can give to this is really not financial. It's just stay calm.
Yeah.
don't overreact.
Well, if you haven't listened to our last show,
Yeah, now we'll play into this.
now you can listen to our last show that we're talking about emotions and how it connects to your investment portfolio over a long period of time. If not, go ahead and listen to that. But in general, Bart, maybe you can summarize quickly really the emotional element behind that.
Yeah, the takeaway from the last show is the investors that work on their own without an advisor tend to buy when they're freaked out. Sell when they're freaked out and the market's at a low.
Right.
And then buy during the euphoria phase when the market has been up for a significant amount of time and market prices are at their high.
And traditionally, if you're an emotional investor, you are buying and selling at the absolute worst times.
Worst times, correct.
Yeah.
So what we're suggesting and hoping that our listeners will do is just stay calm. And if you learn anything from the show, is that we don't know the exact start date of the recession.
Right.
We don't know when it's going to end.
Right.
But what we will do hope is that you maintain a long-term perspective on goals that you've set.
Yeah.
Review your portfolio. Make sure it's positioned properly for your risk tolerance.
Yeah.
Make sure you talk with your advisor about the goals needed to meet your final objectives, whether they be retirement or otherwise. But stay calm and stay the course.
Yeah. And like we talked about, it feels like a long time horizon that you're going through all this because it's in the middle of it. But it does go by pretty quick, like you said, less than a school year. And it's a process. And, we don't know for sure, like you said, how long, if any of this is.
Yeah.
We're just going based off of historical numbers. But stay connected to the people who you know. And there's a lot of news out there. And there's a lot of information out there. And so I can't stress this enough. Like, this is the time you want to reach out to your advisor. And if you don't have one, get one and just say, hey, am I on track? Should I be making any changes? Because, there's nothing wrong with just checking in.
And I'm going to add on to that, and I don't often do this, but since it is, an interesting time, if anyone has further questions on this show, the previous show, our website is zandbergengroup.com. Our contact information is there. We're happy to give a second opinion or answer any further questions.
Yeah.
All right. I hope that wasn't depressing.
I think it's very informative. And in general, like, I think when it comes to the big R word, everyone, it could be scary. And so being able to define it and understand the parameters around it, what you're doing and how you can prepare yourself should give you a little bit of a peace of mind as you're going through that process.
Agreed. Well, we want to thank everyone who has tuned in, and we look forward to being back in the studio next week. Cheers.
Bye.
Tune in next week for the latest edition of the Zandbergen Report, Tuesdays at 2 p.m. Catch up on our recent shows by visiting podcast.bartzandbergen.com. The Zandbergen Report is also available on iTunes, iHeartRadio and Spotify. Interested in being a featured guest on our show or have a question you'd like to hear us answer? Email podcast@bartzandbergen.com. The contents of this podcast episode do not constitute an offer of securities or a solicitation of an offer to buy securities and may not be relied upon in making an investment decision related to any investment offering Access Wealth Management LLC, an SEC-registered investment advisor. Access does not warrant the accuracy or completeness of the information contained herein. Opinions are our current opinions and are subject to change without notice. Prices, quotes, rates are subject to change without notice. Generally, investments are not FDIC insured, not bank guaranteed, and may lose value.